Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss valuation. This is not a very common topic between traders. When you are investors, absolute valuation of the stock market is a very important predictor of what will be your performance at the end of your investment period. When you invest for 5, 7, 10, 20 years, it's really important what is the starting valuation of the stock market at the time you start to invest, and from the starting valuation your total return will really depend. Why this so? There are a lot of the economic reasons, and there are a lot of the valuation methods and a lot of the valuation models that can be used for the stock market. So all of the valuation models are basically trying to answer the questions whether the indexes are fairly priced. Two of the best known are cyclically adjusted price to earnings ratio, which was developed by Professor Robert Shiller. The cyclically adjusted PE ratio, or CAPE or CAPE, uses the earnings and compares the actual price of the S&P 500 to 10 years moving average of the earnings. And the second well-known valuation ratio is the Buffett indicator, known from Warren Buffett, and it compares total market capitalization to GDP. Both valuation ratios, and those are not the only one, there are a lot of other valuation ratios. What we are trying to show you in this article, or what I will try to show you in this video, is that we are trying to introduce a simple alternative. So we are trying to come up with a valuation ratio that's based solely on the inflation adjusted total return of the index. And what is the advantage? So advantage is that it's a simple model, it's not complex, it's not dependent on the data that may be change or that are different across the regions, etc. So it's not based on earnings, on GDP or market capitalization, of all the stocks, which are the data that are very often hard to find. For the valuation ratio that I will try to present, you just need the total return index or total return of the stocks or total return of the stock index plus inflation rate, and that's all. That's the advantage. So it's simple to calculate. So we will use the historical US market data from 1871 to 2025, and we will show what is the impact of the valuation levels on the future performance and future risk over the 3, 5 and 10 year horizons. And then the question is where we are at the moment. So our valuation ratio currently shows that we are in the 6th to 17th percentile range. So the market is probably moderately overvalued, and we will compare what is the current rate of overvaluation to other historical times.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
Why we can use just the simple price or inflation adjusted total return for future valuation or for the valuation of the stock indexes. All of the valuation measures that are used have a common structure. In the valuation ratio we have a numerator. Numerator is always based on the current value of the stock market. So it can be current value of the stock market, it can be market capitalization, price, whatever. So numerator is usually volatile and it's very responsive to short-term market fluctuation. So that's always the numerator. And on the other hand, all of the valuation ratios, they have the denominator. The denominator typically reflects a slow moving variable. And that slow moving variable, it can be GDP, it can be 10-year cyclically adjusted earnings. It can be anything. That slow denominator evolves gradually over time. There are many valuation measures, and if the market is truly overvalued on an absolute basis, they will all signal overvaluation. In other words, so all of the valuation ratios, they tend to differ not in direction, so whether the market is overvalued or undervalued, but in magnitude. So how much is the market overvalued? All of the valuation ratios at the end, whether it's Buffett indicator, CAPE, price to earnings, price to books, whatever, they may show different estimate of the expected future returns of 3, 5, 10 year horizon, but the variability between these estimates is usually a small one. So for example, one valuation ratio will tell you that the predicted return is 5%, another will tell you that it's 7%, another will tell you that it's 4%. So all of them will show that the future returns will be smaller than expected. They will differ by how much. What does it mean is that if you just need an approximate forecast, then you can use also the price-based valuation measures that are, simpler to calculate than some exact valuation. And it will simplify the overall approach, and it will still show you whether the market is overvalued or undervalued and what you can expect in the next 5 to 10 years. Our goal is not to show or tell which valuation ratio is the best. I mean, really, it's up to you. What we will try to do in our video and in our article is to propose a simple price-based absolute valuation measure. So I mean, we are trying to come up with something which is not hard to calculate, and you can calculate it even in some emerging market or the market that doesn't have a lot of the information, because at least what you have is the total return of the index, and you have inflation rate of that current country, and so you can easily calculate the valuation ratio for that country. Let's go to the methodology. So firstly, we created total return index, which is the change in the price of stocks plus dividend yield, and then we calculated inflation adjusted total return index, which is just taking the monthly return plus monthly dividend of the index and subtracting the consumer price index monthly change, and that's all. And once we plot the total return inflation adjusted index, we can see that we have a straight line. So on the average, the long-term average real return is approximately 4% annually in the US market. And this long-term average serves as a historical benchmark. All of the absolute valuation measures generally follow the same principle of the mean reversion. So you select some anchor, and once you are over that benchmark, you expect that the returns will be depressed, and once you are under the benchmark, you expect that the return will be stronger. So in our case, average performance, long-term average real return performance in the US is approximately 4% annually. But we understand that we cannot use the regression over 150 years as an absolute valuation predictor, because I mean, it's not correct methodology, so we cannot use all of the data for the regression, and then to say that in 1921 the market was undervalued and we are using the data from 2020, and it's not correct. So to address this, we introduce a more flexible benchmark. So we are using the 30-year price moving average. So here is the figure 2. So here we have an inflation adjusted total return index series, which is the blue one, and we have 30-year moving average line, which is the red one. The moving average line is intended to represent realistic valuation anchor, and the 30 years is, I mean, good time because it roughly corresponds to one generation of investors. This anchor is like lower values when inflation adjusted total return index is very close to the 30-year moving average. I mean, we can say that the market is cheap, and it really makes, from a generation point of view, and it really makes sense to buy the market because we can expect a stronger return in the future. And now we will do the analysis. So what we can expect, I mean, what can be the future performance in case the market is overvalued or undervalued, and what can we expect from the risk. For that, we need to firstly define how do we measure the risk. So there are two types of the risk. The first one is the maximum drawdown from time of investment. So when you invest for 5 years, you buy the market for a price. The maximum drawdown from the time of the investment is how much money you will lose over the time of the investment compared to the initial value. And then you have a rolling maximum drawdown. So and the rolling maximum drawdown is how much money you lost over the time of your investment compared to the maximum value. So that's a different kind of the risk. Okay, so let's take a look on the total returns by valuation percentile. So we'll open this image in a new tab, and we will take a look on this image in the new tab. Here we have a percentile, so how far away are we from the 30-year moving average. So I mean, here you can see that 0 percentile, or the smallest value, was under the 30-year moving average, and the market was very cheap when we were between 30% and 80% over the 30-year moving average. I mean, really, 30-year moving average is very slow moving anchor. So we can take a look once again on the picture. Here we can see it, so it's very slowly moving. It's nearly always lower or under the total return inflation in adjusted index. The market is overvalued when we are 150 to 350% over that moving average, so we are really far away. Now here is the question, so what is the return we can expect when we are under, are very close to the moving average, and when we are very far away? So here we have a 3-year, 5-year and 10-year performance, and we have percentiles. 25 percentile is something like slightly negative expectation. Median performance is what we can expect on the median return, and 75th percentile is what we can expect optimistically. So let's take a look on the numbers between 25th and median or 50th percentile, which is basically like the average expectation of the future return when the market is really cheap. So we can expect from 8-9% up to 14-15% yearly performance from the equity market, which is above average, or we have really high probability. And the same is for 5 years or for 10 years. So I mean, we can expect very interesting performance. When the market is overvalued, it's between 60th and 100th percentile, we can expect from 0 to 7-8% performance. We can see that the market can be really depressed. The performance from the market or expectations from the market are really depressed when the valuation is high. What is also the problem is that the 10 percentile, which is negative return, so there is a higher probability that our returns will not be good at all, so that will be even negative, and the more overvalued the market is, more significant underperformance we can expect. On the other hand, when the market is cheap, even the 10 percentile return, so even in the bad situation or in the best scenario, we have a significantly positive performance when the market is cheap. So what is the current state? So we are between 70 and 80 percentile. So what we can see is that our future performance of the equities in the US, especially in the US, are not very great. It can be between 0 and 10%. On average, we can expect something like 5 to 6% probably. While on the other hand, when the market is cheap, the future performance of equities is significantly better. Okay, so this is how it looked like from the point of view of the performance. Let's give the quick overview. So even when the market is overvalued, we can still earn some positive short-term returns, but they are not very high. Starting valuation affects long-term returns significantly. Short-term returns are more variable and they're more dependent on luck. The longer you plan to invest, the more important it is what is the starting valuation. The short-term returns are more variable and depend on luck, but still, however, even the short-term lower valuations improve the odds of attractive returns. So that's what I said. Let's take a look on the risk. So here I will open once again the image in the new tab, and here we have how does it look like with the risk. So once again, here we have the valuation percentiles. Here we have the future return percentiles. Median is the expected risk. 75 percentile is optimistic scenario, and 25 percentile is something like realistic scenario, or slightly negative but still a realistic scenario, and 10 percentile is significantly negative scenario. Okay, so what we can expect? So when we have the longer investment time frame, the median drawdown is higher. So we can expect the longer we invest, the more time the market has to show the negative side of the return, and there is higher probability that we will have those negative returns. But on the other hand, the absolute valuation is also the strong predictor of what will be the real negative return of the market. So how much we can expect to lose over the time compared to our initial investment. So when the market is cheap, we are between 0 and 30 percentile. On average, we can expect the small probability of small losses. When we invest for a long time, there can be higher, but there are still between 0 to 10% or 0 to 15%. When the market is expensive, so between 60 and 100 percentile, the probability of the drawdown is significantly higher, and drawdowns can be from 15 to 60 or 40%. Also, the valuation at the beginning of the investment period has a strong impact on what we can expect from the risk. At high valuations, the chance of negative returns is significant. At low valuation, chance of the negative return is minimal. This is absolutely true, and we can see it from the table. The higher valuation increases the risk of sharp drawdowns, even if the investment ends up profitable. When there are high valuation, you still can end up with a positive performance at the end of the investment period, but your journey to the positive returns will be bumpy. So it means there is still significant probability of the sharp drawdowns. On the other hand, when the market is cheap, your investment will end up profitable and your journey to that returns will be really easier. Some tail risk, especially over longer horizons, is non-diversifiable. So what does it mean? For 10-year horizons, at the 10th percentile, drawdowns across all valuation levels are minus 45%. What does it mean? When you want to invest for a long period of the time, valuation is not so important because there is still, some risk that it's absolutely non-diversifiable. So even when the valuations are low and you invest for a long period of time, you still need to understand that you can have a bad luck and you can end up in, Great Depression or global financial crisis or stuff like that. So once in a generation event, and will have a bad drawdowns in the future. So every investor should be aware of this and be mentally prepared to face such outcome. So lastly, one might wonder, where are we now? At the moment it's June, but the market has not moved a lot from the end of the April. We are maybe 5% over the level which was at the end of the April. So the inflation adjusted total return index relative to its 30-year moving average stands at 146%. And let's take a look on the table. 146% is 60 to 17 percentile. So we are still in the 60 to 70 percentile, which is, moderately overvalued market. What we can expect at the current valuation levels, expected median returns range from 10% over 3 years to 7.3% over 10 years nominal return, and risk remains moderate. So it means the maximum maximal drawdowns from the time of the investment are around 5% in median case, but the rolling drawdowns can reach from 8 to 40%. So we are not extremely overvalued, but I mean we are like moderately overvalued. At the current valuation levels, we can still expect from 5 to 10% performance. On average, let's say 7, and our drawdowns can be from 10 to 40%. So let's be realistic, and we can expect like 40% drawdowns in the future. Let's put this current valuation into perspective. So on December 31st, 2007, so just before the global financial crisis. So the inflation adjusted total return index was 122%, so it was lower than at the current time. So the market was cheaper. Today we are slightly above the 2007 pre-crisis levels, and during the crisis the stocks declined 50% in 2008. I do not expect that it will repeat again, but I mean that 25 to 30% drawdown over the next 5 to 10 years is very, very probable. I mean on December 31st, 1999, the peak was at the dot-com bubble, and the index reached to 327% over 30-year moving average. It was the highest historical percentile, extreme overvaluation. I mean we are far from that. So we are overvalued a little, but it's not 2000 level. We can expect the risk in the future, but probably not 50% drawdown. And in contrast, on March 31st, 2009, so near the bottom of the global financial crisis, the valuation index fell to just 9%. So we were in the bottom decile, lowest historical percentile, and I mean the market was clearly undervalued, and there were strong long-term investment potential, and it was really, really strong. From that point the market had a rally and made around 15 or 70% per year over the next 10 years, so it was a great opportunity. So what is the current state? I mean we are not extremely overvalued. There is not a great opportunity to invest in the US market. We can expect bumpy road in front of us. We will probably get a return between 5 and 10%, maybe around 7% in the future. So what is the conclusion? In this article we try to introduce a simple absolute valuation measure, and it's based on difference between the inflation adjusted total return index and 30-year moving average. What is the advantage of this valuation measure is that it's simple to calculate, and you can calculate this even in emerging markets, even the countries that do not give you all of the data needed for calculation for other valuation measures. I mean at least you have the price level, dividend yield of the index, and the inflation rate for that country, and you can easily calculate inflation adjusted total return index, and then you can calculate 30-year moving average, and you can use our table and you can try to guess what will be the performance and the risk in the future. As of April 2025, the US market is moderately overvalued compared to the long-term trend. Although the stocks prices declined recently, they are still not cheap, so we should keep our expectation modest. So that's probably the final conclusion from the whole article. So thank you very much for your attention. I hope that you like the article and you like the video. If you are interested to see how the valuation is calculated, once again go to our article. There is calculation explained. It's very, very simple. We are not saying that it's the best valuation measure. There are other valuation measures, but it's simple to calculate. And I hope that you will join me in the next video. Please visit our blog, visit our page in case you are interested. I mean, subscribe to Quantpedia. There are over 1000 trading strategies prepared for you, and a lot of the different tools for portfolio management. Thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.